Hello Maverick Traders, this is Imre and welcome back to another educational video on how to read a price chart. This video, I'm going to go over possibly the most important concept I know of when it comes to reading a price chart with a high degree of accuracy. And this concept comes down to understanding the two phases of market behavior. There are only two phases of market behavior. We love to overcomplicate things as traders, but the reality is that markets are actually very simple. Trading is hard, but actually reading a price chart is very simple and possibly the easiest part of trading. And yet it is the part, it's one of the parts that people seem to struggle with so much. Now, my belief is that if you can't read the price chart with a high degree of confidence, you're going to see that lack of confidence translate into other elements of your trading, including risk management, including making good management decisions once you're already in a trade, even trade selectivity. So for me, although this is very basic and foundational, it's incredibly important to understand this concept. So like I said, two phases of market behavior. There is what I call the impulsive phase, and then there is the corrective phase of the market. Both these phases together give us a trend, right? So the simplest definition of a trend is that we need to see a series of pivot points moving in concert. So in a downtrend, we need to see lower lows and lower highs, and in an uptrend, we need to see higher highs and higher lows. Without a series of pivot points moving together, you cannot have a trend. So here we have a series of swing points moving down. These are our lower highs, okay? And then at the same time, we have a series of lower lows. So the impulsive phase of the market is going to carry this downtrend to lower lows, whereas the corrective phase of the market is going to put in our lower highs. So this is my personal rule of thumb. As a trend trader, I do not want to be trading once an impulsive wave or phase of the market is already underway. So if we are here, it's too late. I'm not going to be in the trade. I've missed the meat of the move already. What I'm going to do is wait for this next corrective phase and position myself into the market once that phase is over. And then I can ride that next impulsive phase of the market, which is going to go on to have a strong move. So that's why trend trading is so powerful. It's because we see this phenomenon repeat itself over and over and over again. If you're trading for the corrective phase, it's far less reliable. First of all, these moves, the corrective moves, are much smaller than the impulsive moves. Secondly, when you're in the market and you're trading for that corrective move, it's going to be choppy. Okay, here's a perfect example. The market here, although we eventually made a lower high at the swing point here, look at this chop. The market just goes sideways. It just went sideways for an extended period of time before it spiked higher, then spiked lower, then spiked higher, right? So contrast that with this impulsive phase here where the market dropped fairly quickly. Here we have another fairly quick drop. Those are the kinds of trades that I want to be in as a trend trader. So this concept answers two incredibly important questions for me in my own personal trading plan. Question number one, what is the trend? If I see a series of lower lows and lower highs, as I do see here, I have a downtrend. The second important question that this concept helps me answer is, what kind of structure is the market building? Market structure is an incredibly important question for me to be able to answer. So my own trading plan relies a little less on technical indicators and relies a little bit more on chart patterns. So if I'm looking at this chart pattern, right here, then I can answer that question. Well, here we have a start of a strong move, possibly the first wave of a new trend to the downside. And here we have what I would call an ascending wedge or rising wedge, which is a classic reversal pattern. Here we have what I would call a flag. Price action bounded by parallel lines. Here we have another flag. And here we have, again, a very similar pattern, price action bounded by parallel lines. So that's really what I'm looking for. are these chart patterns, these corrective chart patterns that will take place once an impulsive phase of the market has completed. Now, whether you want to use chart patterns or you want to use technical indicators like moving averages or Bollinger Bands, it really doesn't matter. But notice how if you did want to use moving averages, many of these corrective patterns find resistance around the 20 and 50 period moving averages. So that's another powerful technique you can use. How you trade the corrective phase is far less important than being able to identify it and understanding this concept in the first place. So I hope this video was helpful. Like I said, it's a very simple concept to understand, and yet I see so many people that don't know about this. All right, it is right in front of us. We just have to take a closer look at market behavior and understand what's really going on. So apply this concept to your charting. Let me know if it helps. I'd love to know more about how you're getting on with this concept, and if there's anything we can do to help you out, just drop us a comment, like and subscribe to the channel. And as always, we're on the lookout for talent when it comes to recruiting for Maverick currencies. So if you have an interest in prop trading, if you have an interest in trading at a high professional level, please get in touch with us and we'll see if we're a good fit for one another. Thanks everyone. This is Imre. Take care. See you in the next video.